Hi, I'm Peter Rose, founder of Longwood Currency Trading. I've been getting a lot of emails lately, interestingly, from 21-year-old type age group and up in the 40s, low 40s. It's really interesting. They're mostly folks that are either just getting started, less than 6 months, a year, year and a half of trading, or they're thinking about it and they've picked away at it. The problems that they're describing to me that they have are the same problems. The trick is in them understanding that the solution of those problems is different depending on your age. The main reason for that is your risk management, and in particular how you manage your fear. Fear is a huge component of understanding risk management. Nobody wants to listen to any of my videos when I start talking about psychology. I'm not talking about psychology. I'm talking about trading. So if you turn it off, be sure you go and flip it to somebody driving a Lambo with their hat on backwards and telling you how many millions of dollars you can make on a $500 account. People in general learn differently. There's one particular derivation of folks, or deviation of folks. One is they call it field dependent or field independent. And in one group, if you pull out a drawer with kitchen utensils in it, one of the people will be able to say, well, bring out the slotted spoon. And one person will look at that drawer of mess of kitchen utensils, reach in and pick that slotted spoon out. I'm not like that. I can't do that. I'm looking at this confusion of stuff in the drawer, and I have to almost pick out each individual thing or hold it and look at it as a different object so that I can differentiate it. Doesn't mean you're stupid or crazy whether you can do one or the other. It's how you view things, how your brain is wired up. And that translates into the fear component. Again, I'm not talking about psychology. I'm talking about how you look at your trading and how you manage your risk. When you're young, you're not fearful at all, and you should be. And the reason that you are having a hard time is because you're not fearful at the right time. You're greedy all the time. Your greed exceeds your fear. You need to bring the greed and the fear into balance. In martial arts, we look at that and we term that as the Chinese concept of yin and yang. And I mean, you can't have a piece of paper if you don't have a top side and a bottom side to the paper. If all you did was have a top side, which would be impossible, you wouldn't have a piece of paper. So in Einstein and his relativity, E equals mc squared equations, he said there's mass and there's energy. You can't have all mass and you can't have all energy. There's a balance between the two. You can't be happy all the time and not unhappy. There's a balance between happy and unhappy. And there's a balance between fear and greed. Gordon Gekko in Wall Street said greed is good. And it is good. Fear is equally as good, though, because it keeps you out of the deep shit. And when you're young, you have more of the greed aspect than you do of the fear. You're not afraid of losing anything. You're just pressing ahead for that goal. If you learn how to manage that correctly, that's the proper weighting of that you should have. And after years of experience with that, you'll see as you get older, you'll get your not appetite for risk, but your definition of risk changes a little bit. If you're looking at the 40-year-old and above, they have too much fear, and it prevents them from even trading. It's very difficult to get somebody in their 40s or above involved in something supposedly so dangerous as the currency market. You know, the statistics scare the shit out of those guys. 90% of the traders lose 90% of their money in 90 days. Well, why is that? Is everybody stupid? No, it's the education. It's the way that material is being presented. And so if you change the education, then you change the dynamics of those findings of 43 million transactions that a Forex broker did over 25,000 of their clients. Found that though 90% of the traders lost 90% of their money, 72% of the trades that they made were profitable, and yet they still lost. So that's due to the education, or the lack of it. So you can change that part of it, but that doesn't change that when you're 40, you're more cautious. You realize that if you go on a pair of skis and barrel assing down the hill, that you have to be a little more careful than when you're, like when my daughter took up snowboarding when she was like 8 or 10 or something like that. She'd just go like a bat out of hell. And her brother, who was only a couple of years older than she was, but he had more of a different view of the world. He's very interested in the water. We lived on the water, and they both had boats and stuff. But he had a boat a couple of years earlier than her, and she didn't quite have one yet that was her own. So he had more responsibility. Engine breaking down, the Coast Guard had to come and pick him up and bring him home. So he was more thoughtful about things that could go wrong, and she wasn't. Down the hill she'd go, and he never made it down the hill because he was always falling down, because he was always more fearful of falling, which caused him to fall. Then she had no fear, and she'd just go barreling down the hill, and fell very infrequently. And when she did fall, she was navigating the hill correctly, such that the fall wasn't like what my son did, which was faceplant. So the view of the world is really what we're talking about, in the difference between a 20-year-old, 21, 23-year-old, and a 40-year-old. Look, I started studying the financial markets when I was 23. I learned the rules of the game really fast, really quickly. That was 1973, I guess. 1972, yeah, 1973. I started studying the financial markets, and in '74 got into real estate. Spent 40 years in real estate, but I've traded stocks. No, I didn't trade them. Yeah, I did trade them a little bit, and I get into options fairly quickly. And spent 4 years trading options and writing computer simulations against options. I've written computer simulations against commodities, and got involved in the currency markets in 2007, and immediately started writing computer simulations and in-depth analysis of the Forex market, because I saw the tremendous potential that it had after spending 40 years in real estate. I was still in real estate when I discovered the currency markets. I didn't retire and start winding down my real estate until about 2015. And so I had quite a bit of currency market exposure prior to that time, and then made the transition. I said, if I would have known about the currency markets when I was 23, I would have gotten involved in them instead of real estate. I would never have gotten involved in real estate because of I think the currency markets are safer, you have more protection, as long as you have control over your emotions. When you get involved in real estate, the risk management also is inordinately different than when you are trading currencies. It's a component of it's a component of risk management, and the time that you have for problem solution between those two vehicles, investment vehicles. And so you're meeting the same problems, it's just that you're looking at those problems through a different lens, and that forces you to change the way that you solve the problem. I hope that makes sense to you. You can't say, oh, I've got one problem and I'm going to solve it the same way no matter what the conditions are or anything. I know how to boil water, so I'm going to boil water the same way that I've always done. Oh, really? Well, the only time, 99% of the time that you boil water has been down at sea level or within 500 feet or 1,000 feet of sea level. Try going mountain climbing sometime and then try to boil your water and see what happens. Not only does your view change, your psychology changes, the way you interact with your risk, but what your goals are. And so your rules, they remain the same. But it's, as I've said a gazillion times over and over again, when you apply a rule is the difference between successful trading and unsuccessful trading as far as I'm concerned. Other than the fact that if you get shitty education, it doesn't matter when you do whatever it is you're doing because you're doing the wrong thing at the wrong time. Okay? So you really have to get your education squared away. So the difference between the 20-year-old and the 40-year-old rests in how they view risk. How they view risk. It has nothing to do with psychology. It's their view of the risk. How much risk appetite do I have? The 40-year-old is coming to a point in their life where they don't have enough money. And I can say that because at the 65-year-old level, I think the average net worth or the median net worth of a 65-year-old in the United States today is about $110,000. And that's not much. And that's maybe exclusive of the house. I think it's including the house, but let's just say it's exclusive of that. You get your house on the side, you might have another $50,000 there in net worth. But the amount of money that you have available to make you money, or in your 401k or IRA or just locked away in a checking account, is about $110,000. So if you take $110,000 out the first year that you're retired, you're done. If you take out $50,000, you have 2 years to live. So there's that 4% withdrawal rule. You're hoping that your money is making you at least 6%, maybe 8%. It depends on the time frame that you're looking at. And so if you're only taking 4% out, you're taking 4% of that big number, but you're gaining 6% on the big number too. So you get a 2% net growth rate of your portfolio. And so that money should last you 30 years. And then you know all kinds of probabilistic expectations, and 4% is a pretty good number. If you want to be really, really safe about it and you have enough money, you take out less. So somebody who has $1 million in their 401k, God forbid you should do that because you have no access to that money without penalty withdrawals, 9%. But instead of taking 4% out, you'd wish that you could take 2% out because you don't need much more than that. However, the government, in order to get your taxes paid on that money, requires you what they call a required minimum distribution. I don't know where in the world you live, but if you have retirement accounts like that, you're forced to take out 4 or 5%. They want that money gone by the end of your actuarial age. So if you're starting to pull your money out at 70 years of age, they want that money gone by the time of your actuarial age, which is going to be, well, 4 times 20, you get 80% of your money gone. So that's about what they're looking at, because the average life expectancy for a male in the U.S. today is 86 or 84 or something like that. I don't know what it is. So the 40-year-old sees this. I don't have enough money saved that 4% of $50,000 is gonna help me. I mean, I'm paying rent of $1,400 a month, and food has gone through the roof. 60% increase in core food products. Gas has gone up, and housing and rents are out of control. So I'm scared. I don't know what to do. So instead of wanting to take that money and make it grow, they're more afraid of losing what they have than they have really of a desire to make that money grow and to understand risk management. All they can do is look at the failure rate of all you young people that are out there that don't have good education, and you're just throwing shit up against the wall, and it's not working for you, and that's the 90% of the people that fail. The guy says, I don't want to do that, I'll buy bonds. Oh, great, the bond market has crashed. This is April 4th of 2023, and the interest rates have gone sky high, and the Fed is still raising them, and the prices of bonds, it's an inverse ratio, have cratered. They've just gone to shit. Of course, if you have a bond and you got a 6% coupon rate, and the interest rates are now, well, the effective interest rate is 6%. So all you're doing is staying even, but your bond value is way down. So if you went to sell the bond to get the money, you wouldn't have it. So what are you doing? What are you going to do? Invest in Oracle stock or some mining company, or what are you going to do? There's 6,000 stocks out there. So you're going to put it in a mutual fund. Great, mutual funds are down. You put it in a no-load index fund. Great. You're splattered out over the whole market, which goes up and down like a slow sinusoidal ocean wave, and you're going to get 6%. You may get 12% one year, but you probably figure on that no-load fund you're going to get 6 to 8%. That's pretty good, except you're losing money on inflation with it in there. So you could be in cash, like I did. When I sold my real estate portfolio, and I sold my last building 3 years ago, I had money in IRA, I had money in stocks in my regular account, all that stuff, and I called my broker up, not only my real estate broker, the guy that told my stuff. I said, I want that building sold. The last building, the market was screaming, it was going high. If you hold it another year, Peter, you can make another $100,000. I want to sell the building now, and I'll ask next year's price. And called my financial advisor, my stockbroker, and I said, I want to be out of every stock, gone. The market is roaring, it's straight ahead. I had a good friend, a very wealthy guy. He was making 28% on his money in the stock market. He was screaming, he was loving it. Over 4 years, his money had doubled. That's great. When the burps just came recently, he's down about $1 million. Takes a long time to make that kind of money. And so what are you doing? At 40 years old, you're fearful. You don't know what to do. If you go to cash, you're losing the inflation rate, with no idea what to do with that cash. And so you're getting a 4% withdrawal from your IRA, and you're losing 4% because of inflation, and you're behind. You're done. The 20-year-old looks at all this stuff with great anticipation. Stock market is going up. It's crazy. Never heard of a bubble in my life. I'm in there, and you see these guys who took $20,000 or $30,000 and went into crypto, and they became worth hundreds of millions of dollars. You watch Andrew Henderson on his YouTube channel, a Nomad Capitalist, and he deals with a lot of these guys that are crypto bazillionaires, and a lot of them got flushed out when the crypto market went from 80 to 30 or whatever it came down to, and they're levered up on their crypto investment. Quite a few of them went broke. What do you do? What do you do? And there's the conundrum. The person who's young is all in with no risk management control based on fear. And yes, you can make a lot of money until the market turns. But you don't have the maturity to understand when that turn is coming and to clip it and get out. And so you lose far more than you should. The 40-year-old is sitting there paralyzed because they don't know what to do, and their money just erodes away. So you're both cooked. But those problems can be solved the same way. Now, I don't think you can solve it the same way in real estate. If you're in your 20s or 30s, you may not have the money to get involved in real estate. Particularly today, you need a couple $100,000 to get started in investment real estate, because you got to put 30% down. You want to buy your own house, you get 5% down, and you're great. And you got a big mortgage, and when you lose your job, you lose your fucking house. So I don't know what to tell you. The worst that I was ever levered up in my real estate portfolio was 39% against value. So my values came down dramatically, but I never lost any property. I lost $1 million twice in my life, and made it back each time. But it took me 10 years each time because it was real estate. So is the 20-year-old able to get involved in real estate in a big enough way so that you've got a lot of money compounding so that you can do what I did? I started buying real estate when I was 23, so that when I got to 2015 and sold my last building, I had more than made that $1 million loss. I retired well over $1 million. And I did. If I would have held on to that real estate, I could have made, I don't know, a couple of $100,000 more, $300,000, $500,000. It doesn't matter, because I had a plan. When I got 23, I learned the rules of the game, and I had a plan. And here's the plan. This is what I'm looking for. I looked at myself and my personality. I understood one of the first things I learned was risk management, and that was because of my options trading. I had no risk management then. I lost a lot of money learning options. I made that money back 3 times over in a very short period of time, and then it all went gone. So I really sat down and analyzed. Not only did the analysis on what was going on, but I also wrote computer simulation, and I did it using the Black-Scholes equation, which is a really complicated equation, and yet it defines stock options pricing modeling. That's what that equation is for. And I looked at that equation and did some research in my own programming, and I realized why that model failed. And that model failed tremendously in the long-term capital management, I forget what the acronym is, but in the big crash, they went broke, and they had PhDs in math. The guy that one of the guys that I think it was Black, either Black or Scholes, Marion Scholes, was part of long-term capital management's board of directors, and they were doing all the risk management for the company. And there's a flaw in that equation. I didn't get the totality of that flaw when I was looking at it, but I said, man, this isn't going to work at all. This equation isn't going to work at all. And I really didn't, and so I got that. I saw the debacle there, but then I read Nielsen Taleb's book, The Black Swan, or whatever the first book that he wrote was, and he explained the difference between the bell curve that's based on and a fat tail bell curve. It gets pretty technical, but bad risk management. Letting everything go to a set thing. Oh, this equation works great for options pricing. Let's price derivatives, because derivatives are like options against a derivative of stock that's borrowed and levered up 9 times. But it didn't work. And so you just look at the world around you and you say, wow, here's a great set of rules, but when do I put them into play? Here's a concept called risk management. When do I put the different aspects of risk management into play? So that's why in my videos, at the bottom of the video, I say, if you got any questions about this stuff, throw me an email and tell me a little bit about yourself. I want to know how old you are, where you live, so I know what kind of currency you're working in, and what you do for work, and that sort of stuff. I want to know a little bit about you, because I'm not going to give you any advice. I'm not going to answer any question in a comment or in an email if I don't understand who you are, because the answer is going to be different based on not only your age, but your education, the country that you live in, based on the economy of that country, where you are economically, how much money you have access to, how much knowledge of money management that you have. That's the only way that I can help you. I don't know what the rest of these guys out there are doing. Oh, you want to take my course here? It's $500, 100 pages, and good luck. No, not good luck. It doesn't work that way. There's specific reasons that rules are created, but there are specific times, the when component, that you need to apply that rule, and there's a great difference between when you're going to do that, between if you're a 21-year-old as opposed to if you're a 41-year-old. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.